Imagine an advanced artificial intelligence, right? One that is specifically engineered with just one singular purpose.
To find the safest, quietest harbors in the entire global financial market.
Exactly. I mean, it's trained on decades of data just to detect equilibrium,
Right.
to avoid volatility, and above all else, protect capital at all costs.
Right.
But now I want you to imagine watching that exact same AI get just absolutely crushed, like destroyed in a controlled simulation.
Yeah.
All while a rival algorithm, one that's designed to, blindly surf maximum chaos, achieves these record survival rates.
It's a complete paradox.
Yeah.
It really forces us to question the underlying mechanics of, well, will we even consider safe anymore?
Yeah.
Because when the foundation of a market changes, the algorithms built on that foundation, they don't just falter, they actually actively accelerate their own decline.
They just dive right into the concrete. Well, welcome to the Deep Dive. We are thrilled to have you with us today because our mission for this dive is to unpack an incredibly revealing observation log from Team AI Lab.
It's a fascinating data set.
It really is. What we have in front of us is a pure simulation environment. It's this harsh, completely unforgiving stress test of different strategic algorithmic philosophies.
Facing off against live, aggressively mutated market conditions.
Right. So we are going to examine the raw data from this specific simulation and dissect exactly how different kinds of machine logic survive or, spectacularly fail when the pressure is just dialed up to the absolute maximum.
But before we really delve into the mechanics of this simulation, we definitely need to establish the parameters of our discussion today for you, the listener.
Yeah, that's crucial.
We are taking a very strict observation log stance today. Everything we dissect, every data point we talk about is purely a review of proprietary algorithmic behavior.
Yeah, and simulation results.
Right, simulation results generated under very specific, highly controlled conditions.
So just to be crystal clear, we are analyzing the structural integrity of these algorithms, nothing more.
Precisely. This is absolutely not an investment advice.
No.
No one here is suggesting what you should buy or sell. And we are certainly not making any assertions about future market movements. There are no promises of future profits here.
We're treating the market like a laboratory. It's an objective, completely scientific look at how algorithmic logic behaves under extreme stress.
Exactly.
So to really grasp the gravity of this experiment, you need to understand the two protagonists we're looking at. These are two diametrically opposed algorithmic philosophies that Team AI Lab deployed into this simulation.
The first being Team Mountain Climbers.
Right, the mountain climbers. Their core operational directive is equilibrium detection. Let's explain the underlying logic there.
Sure. So mathematically, they operate on the principle of mean reversion.
Okay.
They assume that markets, much like a stretched rubber band, will eventually snap back to a historical average.
Right, so the market is this raging storm. The mountain climbers are programmed to find the eye of the hurricane.
Yeah, a place of balance and stillness. The architecture of a mountain climber algorithm is built to identify assets that have deviated, irrationally from their historical baseline.
Because they assume stability is the natural state.
Right. They basically buy the dip, expecting a return to normal.
Okay, but then on the completely opposite end of the spectrum, we have Team Wave Riders. And their core directive is surging force tracking.
They do not look for stillness.
Yeah.
At all.
No, they actively embrace the chaos. I mean, they are attempting to harness the rough waves and the sheer momentum of the storm to just propel themselves forward.
Right, so in quantitative terms, they are trend followers. Where the mountain climbers see danger and all that volatility, the wave riders see the necessary fuel for alpha generation.
They need the chaos.
They do. They aren't looking at historical valuations at all. They are measuring the velocity and the trajectory of price movements.
Trying to catch the crest of a massive wave before the momentum breaks.
Exactly.
It's just a profound clash of philosophies. One is trying to dig a deep, immovable cave to wait out the storm, and the other is trying to build a windmill to catch the gale.
It's a great analogy.
And the data from this simulation reveals a pretty staggering reality about which logic is actually surviving. Let's look at the season standings, which kind of gives us the context of the overarching environment here.
Yeah, so the data presents what the researchers term an abnormal divergence.
Abnormal divergence.
Right. To understand this, we have to look at the baselines. The algorithms in this simulation are measured against major Japanese indices, the Nikkei 225 and the TOPIX.
Okay.
The Nikkei is a price-weighted index of 225 highly liquid stocks, while the TOPIX is broader. It's a market capitalization weighted index.
Got it.
So we use these as the control group, representing basically the average performance of the market.
Right, they are the baseline of normal. If an algorithm is actually worth its code, it should be outperforming that baseline.
But currently, both teams are heavily bleeding points against these simple averages.
Both of them.
Yes. Team Mountain Climbers are lagging the Nikkei 225 by 7.6 points.
Wow.
And the TOPIX by 2.7 points.
And just for context for you listening, when we say points in this simulation, we're talking about a proprietary scoring metric used by Team AI Lab.
Right.
It's a calculation that factors in the algorithm's return relative to the benchmark, but it's adjusted for the internal risk and leverage parameters of the simulation.
Exactly.
So a negative divergence of 7.6 points, I mean, that is a massive underperformance.
It really is. But what makes this an abnormal divergence is that T-Wave riders, our momentum-driven chaos surfers, are also lagging the baseline indices.
Wait, really?
Yeah. They're down against the Nikkei by 6.0 points and the TOPIX by 1.2 points.
Right, let me stop you there because this is the fundamental paradox of the data. If the strategy seeking stillness is failing,
Right.
and the strategy surfing momentum is also failing to beat just the dumb average, what is the root cause? I mean, is the internal math of both these highly tuned philosophies fundamentally broken? Or has the very definition of normal in the market mutated so fast that the historical data these models rely on is just obsolete overnight?
The telemetry strongly indicates a severe market mutation.
Yeah.
When highly sophisticated specialized algorithms broadly underperform a simple passive index, it suggests the ecosystem itself is experiencing a regime change.
A regime change.
Yes.
Makes sense.
The existing logic, the historical correlations between asset classes, the expected volatility bands, it's all broken down.
So the algorithms are effectively navigating with maps of a landscape that just experienced a massive tectonic shift.
Yes, that's a perfect way to put it.
Yeah.
In a rational environment, at least one of these philosophies should catch a tailwind, right?
Right. Okay.
If the market is ranging and stable, the mean reverting mountain climber should generate consistent points.
And if the market is in a strong directional trend, the wave riders dominate.
Exactly. So the fact that both are struggling against the baseline means the environment is exhibiting volatility without clear direction, or trends are reversing with a violence that just completely defies historical modeling.
It's a nightmare scenario. So how does an artificial intelligence fight back when the environment turns that hostile?
It rotates its forces.
Right, it rotates its troops to gather new data. And this brings us to the really dynamic mechanics of the daily logs. Specifically, the contrast between the main forces, the algorithms that have been grinding through the simulation, and the new forces that are just being deployed.
Right. The simulation runs on a mandated tracking protocol, heavily relying on a 10-session roster system.
Okay.
A session here basically correlates to a single trading day. An algorithm is deployed into the live simulation, it executes its logic for 10 sessions, and then its final scorecard is tallied before it's rotated out.
We saw this rotation happen at 9.000 JST today, perfectly aligned with the opening bell in Tokyo.
Yeah.
Team AI Lab drafted new units to test their logic against this mutated environment. They deployed 3 new mountain climbers and 1 new wave rider. These are our new forces.
And the deployment of these new forces is highly, highly strategic. They're sent into the exact sectors where the exiting main forces just experienced extreme stress.
It's like a recon mission. It's like dropping fresh paratroopers into a jungle where the previous squad just went totally silent.
Right. We're throwing them into the exact spots where the old logic failed, just to see if they've learned the new rules.
Right. But to really understand why these new forces were drafted, we have to look at the carnage the exiting main forces just went through. Let's look at the mountain climbers that finished their 10-session mandate today. Where were they deployed?
They were positioned in services, pharmaceuticals, and information and communication.
Okay, those are traditionally the ultimate defensive sectors.
Absolutely.
The logic is pretty straightforward, you know? No matter what the macroeconomic environment is doing, people need healthcare and they need basic societal services.
Right. If you want equilibrium, you park your capital there.
That is the textbook application of equilibrium detection. But in this mutated environment, that historical correlation completely failed.
It collapsed. The exiting main force mountain climbers ended their 10-session mandate with a final total score of negative 42.9 points.
The negative 42.9 points. I really want to emphasize the mechanics of that failure for a second.
Yeah, please do.
A mean reverting algorithm buys an asset when it drops, assuming the drop is an overreaction and it will bounce back to its average, right?
Yep.
But if the sector is undergoing a structural repricing, say, Due to a sudden shift in global interest rates or some regulatory shock, the average is permanently moving down.
Yeah.
So the algorithm just keeps buying the dip, catching a falling knife over and over again until it bleeds out 42.9 points.
You've perfectly described the vulnerability of mean reversion during a regime shift. The mountain climbers assumed those sectors were solid bedrock.
And the data proved they were quicksand.
Exactly.
Yeah.
Now contrast that with the exiting main forces from Team Wave Riders.
Okay. They deployed into electric appliances and precision instruments.
Historically, those are highly volatile, cyclical sectors.
Very rough waters.
Right. They are hypersensitive to global supply chain disruptions and semiconductor demand cycles. They represent the roughest seas in the market.
And their final score after 10 sessions, plus 41.7 points.
It's credible.
It is. The algorithms that threw themselves into the absolute highest volatility conquered the chaos, while the algorithms seeking safety in pharma just drowned.
The underlying mechanism here is momentum decoupling.
What does that mean exactly?
Well, the Wave Rider's surging force tracking logic doesn't care about the intrinsic value of an appliance manufacturer. It only cares about order flow imbalances and price acceleration.
Okay.
In this simulation, the momentum in those tech-heavy sectors completely decoupled from traditional valuation metrics. The Wave Riders latched onto that sheer velocity and surfed it, turning a staggering 41.7-point profit.
So the mountain climbers were sitting in a cave waiting for a stillness that literally never arrived,
Right.
while the Wave Riders built a windmill in a hurricane.
Exactly.
But this is where the data demands a deeper level of scrutiny, I think. We cannot just look at the exiting forces. We really have to examine the active roster. These are the units currently in the middle of their 10-session deployment.
Yes, and this is where we find anomalies
Right.
within the broader failure.
Right, because despite that massive negative 42.9 exit score for the exiting climbers, when we look at the 25 active mountain climbers currently fighting the simulation, 16 of them are maintaining positive point balances.
Yeah.
And out of the 15 active Wave Riders, 9 are holding positive.
We have to zoom out to see why this is so striking.
Good.
For the entire season, the mountain climbers as an aggregate strategy are operating at a deficit of negative 9.7 points. The Wave Riders, buoyed by those tech sectors, are sitting at an overall positive 46.2 points.
Okay.
But those 16 active climbers, they are succeeding, where their underlying philosophy is generally failing.
Which is why we call these units lighthouses in the dark.
It is an incredibly apt description. The indices are behaving abnormally, the traditional safe havens have totally collapsed, and historical rules are failing.
Yeah.
Yet, these specific active units are maintaining structural integrity and actually generating positive scores.
Okay, but this requires serious pushback. As an observer of this data, I have to question the validity of these so-called lighthouses.
Fair enough.
If an environment is this chaotic, and an algorithm is only tested for 10 sessions, how do we actually know these 16 climbers figured something out? I mean, in quantitative finance, a 10-day sample size is incredibly narrow. If I put on a blindfold and throw darts at a board for 10 days, I might hit a few bullseyes just by sheer variance.
True.
How does Team AI Lab differentiate genuine, mathematically repeatable adaptation from just, statistical noise? Like, did they just get lucky and happen to be standing on the one piece of land that didn't sink today?
That is the most critical question in any algorithmic evaluation. The risk of overfitting a model to a random anomaly is ever present.
Exactly.
However, the 10-session mandate is not merely tracking the final point tally, it's actually tracking the underlying decision pathways.
Expand on that a bit. How does observing the pathway filter out the luck?
Well, if an algorithm is merely lucky, its positive score will usually stem from a single, outsized variable.
Like it bet the farm on one stock.
Right. Perhaps it overallocated into one specific pharmaceutical stock that happened to get patent approval that day. That is variance.
Okay.
But the simulation tracks the breadth of the algorithm's decision tree. Are these 16 climbers generating points across multiple micro-decisions? Are they identifying a new, localized form of equilibrium that is invisible on the macro scale?
So you were looking for the consistency of the micro wins rather than one lucky home run.
Correct. Furthermore, the algorithms are subjected to adversarial cross-validation within the simulation.
And adversarial cross-validation.
Yes, they aren't just trading against static historical data, they're interacting with the simulated market environment dynamically. A lighthouse algorithm is one whose internal parameter weightings, things like its volatility scalars or its look-back periods, have organically shifted to match the new frequency of the market.
Oh, I see. So if a standard mountain climber uses, let's say, a 50-day moving average to find its equilibrium,
Right.
maybe these 16 lighthouses dynamically shortened their look-back period to, like, 5 days?
Yes.
Effectively shrinking their definition of stillness just to survive the immediate turbulence?
That is precisely the kind of micro-adjustment the researchers are looking for. The lighthouses represent a localized, hyper-specific application of equilibrium detection that actually functions within a mutated market structure.
Man, that's fascinating. And this brings us to the overarching philosophy of Team AI Lab, and really why this strict observation stance we took at the beginning is so vital.
It is.
It fundamentally changes how we perceive a quote-unquote loss. When we see an algorithm bleed out negative 42.9 points, human instinct just labels that a catastrophic failure.
But in algorithmic research, there is no such thing as a failure. There is only a mapped boundary.
A mapped boundary, I love that.
A negative 42.9 point score is an incredibly high fidelity data point. It provides the exact mathematical coordinates where the historical logic of mean reversion completely breaks down.
It's like, I look at this process kind of like crash testing a vehicle. If an automotive engineer runs a prototype car into a solid concrete wall at 60 miles an hour, they don't look at the pulverized front end and say, well, we failed to keep the car intact.
Right, because the destruction was the explicit intent of the test.
Exactly. The engineers run the car into the wall to measure the exact shear stress on the steering column to map the kinetic energy transfer through the chassis. The market in this simulation is that concrete wall.
Yes.
The mountain climbers in the pharma and services sectors just hit that wall at maximum velocity. The telemetry data generated from that impact is what actually matters.
And that telemetry dictates the parameters for the next iteration. It tells the developers exactly which variables in the equilibrium logic require adjustment before the next 9.00 JST draft.
Right.
It forces the quantitative models to redefine what equilibrium actually looks like when the macro environment is undergoing a structural shift.
It really strips away all the psychological baggage of trading, doesn't it? I mean, there is no human panic, no fear, no doubling down out of stubbornness.
None of it.
It is simply cold, forward-looking observation.
It is the scientific method applied to market survival, accelerated to the pace of daily trading sessions.
Right.
The Wave Riders generating plus 41.7 points. That is data confirming a successful adaptation to momentum decoupling.
And the climbers losing 42.9 points.
That is data highlighting an evolutionary dead end in the current volatility regime. Both outcomes are equally necessary for the next phase of development.
Data for the next victory. So what does this observation log really leave you with today? We have analyzed a simulation where the basic physics of the market temporarily inverted.
Right.
We saw the algorithms built for safety get absolutely decimated in historically defensive sectors, while the algorithms built to serve sheer volatility thrived in the most turbulent waters.
And we observed the critical difference between macro-level failure and micro-level adaptation through those lighthouses holding positive scores.
It leaves me with a pretty profound, lingering question to consider. If an unfeeling, hyper-advanced algorithm is forced by the mathematics of a simulation to completely abandon its historical definition of safety and stillness just to survive a regime shift, what does that imply about the rigid systems we rely on as humans?
That's a great point. It highlights the danger of relying on static maps in a dynamic environment.
It really does. When the foundational rules of the environment change, the safe cave basically becomes a tomb. And the only way forward is to learn how to ride the wave. If the algorithms are proving that rigid historical models lead to negative 42.9 point wipeouts, it is a powerful reminder that adaptation is the only true form of equilibrium.
Absolutely.
Now, if you want to continue exploring these complex quantitative environments with us, I need you to do 3 specific things. First, subscribe to this channel. The market environment in these simulations mutates rapidly, and we are dedicated to tracking every structural shift.
The iterations provide constant new telemetry. You don't want to miss it.
Second, check out the description below and click the link to visit the Team AI Lab Substack. That is where you can view the foundational observation logs for yourself.
Highly recommend it.
And third, to truly understand the deeper mechanics we discussed today, sign up for the Substack paid subscription. That will grant you direct, unfiltered access to the granular analytical data, the parameter tracking of those specific Lighthouse algorithms, and the raw evolutionary metrics being generated by the simulation.
It essentially provides the full architectural blueprint of the crash test.
Thank you so much for joining us on this deep dive. We really appreciate your intellectual curiosity. Remember, it is only when the clean math gets thrown out the window that we discover how the system actually works. We will see you next time.